Doing well, Jan. Doing well. Watching the markets, trying to understand what's next. This is not boring times.
No, it's certainly not. And on the back end of our risk challenge sessions, I think this is a good time to dive into some of the questions that we've been getting since then, and namely questions about what scenarios are most appropriate for the current environment. And I know that you've had some conversations with clients. I've had some conversation with clients, but why don't you mention what you've been telling clients that they should be looking at?
Well, I think there are reminding people that the core philosophy of risk management that what we propose is that you work on scenarios or stress tests. You don't try to predict the future. You also don't look at volatility, past volatility. It's really it means very little for the future. You try to create plausible scenarios and understand where you have exposure. When you have exposure, you have to decide, okay, is this position important for me? Is this enough? Because risk has to be viewed as a cost. Risk is just a cost. You spend risk just like you spend transaction fees. And so the goal of the stress test, the goal of stress testing is to understand where you spend that cost, where you spend risk. Yeah. Well, if you understand that, then you can decide, I keep this position or I get rid of it. So with that in mind, in portfolio crash testing, we have a bunch of scenarios that our clients use. And we periodically update them. And these are scenarios that created by RiXtrema team, by us. Clients can also create their own custom scenarios. And we have a list of like 12 to 15 main scenarios, but there are hundreds of others. And from these main scenarios, I feel like, and I don't just feel it, I think that people should focus on three scenarios, and I can substantiate that. The first scenario is called Fed hikes rates and keeps tightening. Surprising, we had this scenario for a while before current events, but this is exactly what is going on right now. Federal Reserve is in a bit of a corner because they've pre-announced a major rate hike schedule, and they're going to have to stick to it. I think this is a bit of a speculation, but it's hard to see them backing out of it unless there's a major recession. Not even like not just a recession.
Yeah, I mean, I think they've really backed themselves into a corner with that. I mean, they're going to have to keep on going, otherwise, their credibility is what's on the line here. So
exactly, if they went like a year earlier, they would have been able to back out, back off. Now I think they're going to go with most of these hikes. They've announced going to 3.5. I actually don't think that's going to happen. I think they're going to see a major recession before that, but they're going to go pretty far into it. And so the whole idea between the scenario we created, Fed hikes rates and keeps tightening. I'll read the description from our software, portfolio crash testing. The description is that this is a scenario for surprise taper by the Federal Reserve. So this is one of the scenarios we had before for months actually.
Years, I think, actually.
Huh?
I think years actually we've had this up there.
Couple of years, yeah, maybe a couple of years. Yeah. So
and the word surprise would probably have to be removed from our description to describe today, because it's pretty well telegraphed.
That's right. And but note that our scenario, I'm looking at the actual shocks that comprise the scenario. The first one is a 30-year going 150 bips up, which is that's a, I don't want to say catastrophic, but it's a very serious move now. Given all the debt, just servicing the debt will be massive costs to the government. We also had gold going down in that scenario. And this is what we're seeing play out. This is a kind of, I believe that right now, by recent actions, Federal Reserve narrowed the window of the type of scenarios we need to look at. So we had 30-year going to 150 basis points up from now, moving up. Gold down 20%. Also in that scenario, we had home equity spread, AAA nonetheless, right? So not some junk spread, AAA spread widening by 300 bips. That means massive, or not massive, but I don't want to kind of overstate every time, but a very serious reduction in house prices. And also, I think we're seeing some of that. Okay.
We're definitely seeing some slowing in the markets. I'm not sure it started to the point of reduction yet, but I mean, it's early days.
Yeah, but we're again, the Fed didn't do much yet, right? They
Right.
just started. They announced this massive move. So, and the rates are, you know, it's very interesting the way a financial system is set up, in that Federal Reserve, by increasing rates at the short end, is creating, supposedly they should be raising all interest rates. But that's not going to happen, because in a lot of the world financial system is set up so that a lot of whenever there's a recession or a crisis in the world financial system, which is going to be induced for sure by these rate hikes, all the capital flows to the center of the financial system, which means US Treasuries. So people will want to buy US Treasuries. Now, I don't know to what degree, but it's still going to happen. I don't think there's a lot of changes in geopolitics and so on, but I don't think the legacy financial system is broken. I think, well, it's broken, but it's still functioning, right? So what we're seeing is the Fed is going to be raising the short end of the curve. At the same time, people will be buying the 10-year, 30-year especially. So in other words, when you're looking at these scenarios, there's no precision. You don't want to be trying to predict things, but this is one plausible scenario that you must run. If you use our software portfolio crash testing, or if you have your own stress testing system, you should be able to model that scenario. Again, you're shocking a 30-year rate up about 150 basis points. That's a significant move. That's like 2.5 standard deviation move. Gold down by 1.5 standard deviation, and then home equity spreads are up. So that's really the cost of borrowing for a house is really increasing. You want to run that scenario in your portfolio and see which position. I just talked to the advisor, our client, who has a few of their clients looking at this situation, and they ran it and they saw that there were two positions in the portfolio that were high contributors to risk if the Fed keeps tightening. What you want to understand is these two positions, are you prepared to stick it out? Are you prepared to incur possible losses? Right? It's not, the risk is not good or bad. It's just a cost. You just need to know what you're doing.
Right. It's not even like, are you prepared to, do you have enough conviction in those names to stick through that scenario? I mean, are those the place where you want to spend that risk capital? Are those where you have conviction? Because if you're seeing something in that analysis that these two positions are your biggest losers, and that's a surprise to you, well, that should raise all kinds of questions about how you actually feel about those and the likelihood of that scenario playing out. Yeah,
exactly right. So you should have, in other words, in other plausible scenarios of the world, you should always have in mind, in our crash testing software, there's like 12 scenarios, but you should keep in mind always at least 5-6 scenarios. Any good portfolio manager, money manager, investor keeps 5 to 6 different macro scenarios on their head and kind of ruminates on them, right? So if in this Fed hiking rate scenario, which we're in the middle of actually, something is losing you a lot of money, it better be making you a lot of money in some other scenarios that you keep in your head, right?
Right.
So then,
well, I think, oh, good.
Right. I could even show the screen here. I forgot that we have this capability. So I was showing this Fed hikes rate scenario. That's our portfolio crash testing software. The second scenario that are really...
Well, before we move on to that, Daniel, just real quickly, one of the ways that I would suggest that clients might think about editing this, or even, we might think about putting in a new scenario here is we talked about different magnitudes on different sides of the curve. And one of the things that we're not really doing in this scenario is we're not changing the shape of the curve. We're saying we're kind of shocking one point. Well, what you can do is you can also shock the short end of the curve to an amount that could cause that curve to flatten a little bit or something like that, because that's kind of what we see.
Or invert,
happening too.
which is going to have to invert if they keep it up, right?
Exactly.
Implicitly,
exactly.
We are inverting it because, well, we're not. I mean, you're right. Yeah. So the only problem with shocks at the short end of the curve is that in the last few years, Federal Reserve made it so that the short end of the curve is not a random variable anymore.
That's right.
So the math stops working, and you have to be sort of cautious. You have to go out probably a few years out at least, but you can't do like a 1 year.
Right. That's yeah. And that's more of what I was
Zero.
thinking. That's a great point. So maybe 1 to 2 year point on the curve, you could actually start to, shock that as well. But because you're absolutely right, the shorter ends are completely manipulated.
Yeah.
Okay.
So the other scenario that I think we should be looking at, every advisor should be looking at, is the Fed severe adverse scenario. This is not a scenario we made up. We actually got it right off of the Federal Reserve stress tests. And remember, Federal Reserve before 2008 didn't use stress testing much. It was mostly about value at risk.
Right.
So for advisors that use risk systems right now, if you're using anything like a risk number, anything with one risk number, that is one way of doing risk. Stress testing is a different way of doing risk. So Federal Reserve after 2008 switched almost exclusively to stress testing. Most of the decision making happens based on stress tests. So this is their scenario. Notice that both euro and Japanese yen are down significantly. Pound is down less.
Moderately, yeah.
In fact, I would argue that this is a different scenario, obviously, because the rates are down significantly.
One thing about this scenario that's not in there is that there are more. I don't know if we have a limitation on how many we display here, but there are more variables in here. We did a whole blog about this scenario some time ago, and it tells you what every single factor is underneath it, because there's stresses to not just the corporate spreads, but there are stresses to a few different points on the curve, like we have here. There's stresses to the European markets, to the US markets. It's a very detailed scenario that they put in to this Fed severe adverse. And there's only two scenarios now. There's the severely adverse scenario, and then there's the baseline scenario. There used to be three, but now there's only two. But there's, it's pretty well involved, and you can read about it on our blog and or in their documentation. Certainly.
Yeah, I don't know why they had for a 6-month curve 220 bips down. I mean, that effectively means that the shock is not in play, because the 6-month would just go to zero, which
Exactly.
is not that far from zero. But what I'm seeing in that scenario, that the Fed had also a 5-year basically going close to zero, and the triple B spread widening significantly. So this is, I would say, to some degree, it's a little bit like 2008 crash, with the focus on interest rates. But I would note that this scenario, we talked about the Fed hikes rates, but this scenario is also in play now. We not the rates part, right? Because the 6-month rate is going up, but some of the other variables, like for example, like euro and yen, are down significantly over the past month. We're seeing volatility.
Yeah.
So what the Fed was trying to do here is simulate flight to let's put quality in quotes here, to save flight to safety. And because in the current financial system, treasuries are safety by definition. It doesn't matter what the reality is. It doesn't matter how many treasuries are issued or anything. Treasury is the safe haven asset, and that's it. Until this financial system is no more, that's what it's going to be. And so that's what they simulated here, right? Triple B corporate spread going up 340 bips. That's essentially signifying a stock market drop, because if you think about what triple B borrowers are, those are pretty solid companies. This is not your, this is not your B minus, triple C.
Right.
So a solid corporation, which right now they have a lot of cash and so on, for them to lose their privilege of getting the loans at a cheap rate, that means there's a major shock. And so I would argue that we're in the middle of the Fed hikes rate scenario. And from here, it could go to a couple of ways. One is the Fed severe adverse. So this could be the next stage. If this is over, then this stage could ensue. That's why you need to run that one and understand how your client's portfolio will react. Okay. So the other scenario that I'm actually, it's not on this card, but it's the stagflation scenario. I want to look at, see, I don't have.
Yeah, I think I have it up on my card if you want me to
Yeah,
share
why
my
don't you-
screen. Let's see. Oh, you got to let me. Yeah, I mean, I think the stagflation scenario, there's been so much talk about it that it's really become one of the top things that we've been hearing about from clients, seeing in the news. But it's right here, the rates rising with stagflation, and you know, this has a little bit of you know, the kind of the 2 points that we were talking about, 100 basis point rise on the short end at the 3-year point. 30-year has a 300 basis point rise, so you know, much more than the Fed hikes rates and keeps tightening. You know, this kind of shows that they're really doing something active to actively fight this you know, inflation. So it's a little bit of a different scenario, but here we have gold up, and we only have the S&P down 5%, which is you know,
because that's what's going to happen in stagflation. I mean, we're not,
well,
there's a lot of talk about stagflation. We're not in it yet.
exactly what I was going to say. Yeah. Yep.
I think in the stagflation, what you end up having is nominally the value keeps about flat. I've studied the 1970s, which was the kind of the quintessential stagflationary shock, supply side shock scenario. And obviously in that period, the nominal value in the end didn't do so badly. Obviously you lost a lot of purchasing power, so it's not ideal. I think that if you look at the stagflation scenario, you will notice that, right, the essence of it is that they're both rates and gold go up. This is why you see it says rates rise stagflation,
Yeah.
but we have other rates rise scenario. I don't know if you have it, but we have rates rise inflation. And then
I don't have
rates,
that one here. Yeah.
there are other ones. So rates rise, inflate. So the point is interest rates are not a definitive factor. If you say rates rise, that means very little, because rates could rise for many, many different reasons in many different environments.
Yeah.
And stagflationary rates rise is different from like an inflationary boom type rate rise. So in the stagflationary rise, what we see is we have increased interest rates, obviously, because there's inflation, but we also see commodities go up. So gold go up. We also see stagnation in the economy, which is what's indicated that despite the major rate rise, you don't have the corresponding move in the equity markets going up. That's why the S&P 500 down 5% sort of controls for that factor.
Right.
And the idea here is that stagflation is it's a kind of a secular environment. This is not something you get for a few months. Stagflation runs for years. We're not there yet. We're probably in the middle of the Fed hikes rate scenario, most likely.
Right.
We're in the middle of it. And the Fed, so from there, imagine like a fork in the road. So when Fed is done hiking, and I think they're going to go very far, they're probably going to overshoot it, just like they undershot before. And then we're going to have two choices. Either they're going to continue all the way down, you know, risking kind of pitchforks and unrest. And in that case, if they do, they will see the Fed severe scenario.
Mm-hmm.
But if they back off and then reflate, which is also possible, then we're going to get stagflation. I think there are, and this is a little bit subjective, but there are many scenarios, right? A good risk manager, if you use this portfolio crash testing tool that's part of our tech market for financial advisors, you will look at all these scenarios and you will look at contributors, but I would focus on these three.
Well, I think, you know, I think,
yeah.
No, sorry, no, sorry. Stagflation, Fed hikes rates and keeps heightening, and the Fed severe adverse scenario is what what I interrupted.
Exactly.
But I think we should probably do in one of our next podcasts, videocasts, whatever you want to call this, is we should talk about how to design a good stress test, because you know you said this several times throughout, and it really needs to be stressed. This is really important. This is not, you know, you can't know exactly what's going to happen in a rate rise stagflationary environment, but there are, you know, assumptions that you're going to make. There are variables that you need to control for, because one thing that you said that is very important rates rising on their own is not the definition of a scenario, right? Just like, oil prices going up is not the definition of a scenario. You need to have other control variables in there. Is oil going up because of a supply shock or a demand shock? And those are very different. Are rates rising because the Fed's doing something like what it's doing by heightening, or is it because of stagflation, or is it because of inflation? These are different scenarios that need to have other factors expressed. So we should probably talk about that in a future episode.
Yeah, absolutely. And also we need to think about how the correlations work, because when we move 3-year, 30-year in a gold and S&P, that doesn't mean that those are the only factors that move. For example, absolutely. A move up in gold is going to affect many other commodities, right? In a certain way. I will say this, for this client that I spoke with, I also suggested to them that we will create for them a custom scenario, which we're probably going to make a common scenario, is a stagflationary with the food price shock. Because right now, what we're seeing is very interesting, sad, but interesting. So we've had a major inflation run up for the past 2 years, actually. This is not a new phenomenon. But right now, we're actually seeing two forces. We're seeing rampant inflation. We're also seeing major deflation because of what the Fed is doing. And how it's going to play out, nobody knows. But in the short run, we even see like food commodities dropping in price, which is strange, because usually when you have food inflation, it doesn't stop so quickly. It's not like we have a bunch of new food produced in the past month, right? So something is going on where the Fed, just by threatening this Fed hikes rates scenario, they got some deflation that simultaneously kind of works with inflation. The question is, what's going to happen in the end? Either they're going to create a deflationary recession, or they're going to create stagflation, or it could be all good and normal, which is not that likely at this point, I think, but it's possible. So the scenario that we're going to add for our clients is that it's going to be like a stagflationary scenario, but instead of focusing on gold, the monetary metal, we'll focus on staples, commodity agriculture. Right. And I think it's very important to understand how that scenario plays through your portfolio.
Yeah, I mean, what I've seen, and it's been contrary to what I've believed because of the what's going on in Ukraine and Russia. I really thought wheat prices were going to go kind of crazy, and they've gone exactly the opposite direction that I've expected them to. But I think we should add some of that.
I think it's temporary. I think this is a big mistake to view this as anything other than a technical,
it could, yeah, absolutely, because it doesn't make any sense. But I have read about gluts, and so maybe we should bring that up. Maybe that should be the topic of our next podcast here, and we should leave this here for today.
In the next session next week, we'll talk about the progression. I think that it's important for people to understand that very likely we're going to see temporary deflation. Lots of things will be on sale, but that's not because there's some fundamental change in things that produce. It's because there was a lot of hangover post lockdowns and all that kind of madness, where all of a sudden transportation opened up. So we had a bunch of things that were delivered, and it's flowing, and something is working. And even the backdrop of this war is not enough, right, to curb that. So we have deflation, where people are clinging to the dollar. It's like an old habit, you scare them and they go into dollar and treasuries, and they even sell food to do that. Mm-hmm. I'm talking about traders, right? Not people who eat. People who eat, obviously, they will eat regardless. So I think that we'll talk through the next call. We'll talk about a scenario that we'll create that has to do with food. And this is a little bit speculative, but I do believe that after this low price, this deflation will be very evil, because it is not a real supply boom, right? We're not getting more supply. It's just technically people go into dollars to protect themselves from margin calls and so on, in different areas of the market, right? They're protecting themselves from margin calls in tech and so on, but they have to sell something. So, maybe we'll sell food here to deliver some cash. Once that's worked through, it will be even worse, because this lower price also will hurt supply in the long run, because the prices for like fertilizer, no matter what they are, there's problem with logistics right now. You just can't get it. Right. There's problems with transportation because energy is still very high. So those things have not gone away, but the price at which you can sell future wheat just dropped. So your costs remained elevated. So what are you going to do? Are you really going to grow extra food this way? Maybe not. Maybe some people will not. And so we're going to end up in a scenario where the prices will kind of go much higher because of this temporary pullback, because it's going to have a detrimental effect on supply. In the next podcast, we'll talk about how to create that scenario.
Yeah, and I will say too that the wheat prices are still very high relative to their history. They're just not, they just kind of went up to a pretty high level and came back down, but they're still at a level that I think people can get compensated, very well for, even with the inflationary, fertilizer and everything else, if you can get the stuff. So yeah.
Well, I mean, if they were higher, there would still be more supply coming in a few months. There would still be more incentive to, there's always a break-even price and so on.
Yeah.
So I think that we're going to see temporary deflation followed by either deflationary recession, or we're going to see, kind of stagflation after that with prices exploding.
All right. Until next time, Daniel.
All right.
We'll leave it there.
Thank you, everyone.
Bye.
Thank you for listening. If you have any questions, I guess you can comment, or wherever you're reading this. You can also go to RiXtrema.com/blog, and you can see all our blogs there on videos. You can comment there. If you have questions, you can write to support@RiXtrema.com. Or if you want a demo of portfolio crash testing, you can see how that scenario works for your clients. You can write to support@RiXtrema.com.
Thank you.